Porsche just reported a 3% global sales drop in 2025. And that tiny number might be hiding the biggest warning sign in years. Porsche's global sales just slipped by 3%. But don't let the small number fool you. Behind it lies a storm of falling profits, rising tariffs, and shrinking dominance in key markets like China and the US. Is this just a slowdown or the start of a major shift for one of the world's most iconic automakers? Let's find out. Before we get into why Porsche's 3% sales drop matters more than it seems, hit subscribe and tap the bell so you never miss what's really driving the auto industry. Alright, 3% might not sound like much, especially for a brand as powerful as Porsche. But once you look under the hood, this small slip reveals something much bigger. Let's break it down. A small drop, or the start of a steep fall. When you hear that Porsche's global sales declined by 3% in 2025, it might not trigger alarms. After all, in a world where numbers bounce up and down quarter after quarter, a single-digit slip seems manageable, maybe even expected in an industry facing electrification, regulatory chaos, and volatile economies. But for a brand like Porsche, numbers don't just tell a story. They warn of what's coming. The drop from 77,640 units in Q1 2024 to 75,800 units in Q1 2025 isn't just about volume. It's a warning bell ringing across Stuttgart, Munich, and Wall Street, because in Porsche's world, where precision, demand, and profit margins form a delicate triangle, a 3% loss doesn't simply represent fewer cars sold. It represents a structural strain on a tightly engineered business model. Unlike mass-market car makers, Porsche operates in a premium segment where sales volumes are modest but margins are high. They're not trying to flood the roads with units, they're trying to craft every delivery as a statement. But what happens when demand softens and costs rise simultaneously? This 3% drop is about more than a number. It marks the intersection of slowing Chinese demand, punishing US tariffs, rising operational costs, and a rapidly shifting luxury buyer mindset. Let's dive into the financial core of this, because the sales decline is just the tip of Porsche's problems. Sales aren't everything. Profitability is what keeps a brand like Porsche ahead of the curve. But in Q1 2025, those profits weren't just down, they fell off a cliff. According to Porsche AG's quarterly report, operating profit from the automotive side plummeted by 43.8%. Total company profit was down 40.5%. Think about that. For a company with famously lean manufacturing, obsessive cost control, and a customer base that rarely blinks at six-figure price tags, a near 50% profit drop is massive. Even more alarming was the fall in return on sales, down from 14.2% to just 8.6%. That means for every euro Porsche earned, it kept significantly less than it did the year before. If we dig deeper, the automotive division's net cash flow also fell by 91 million euros, which speaks to liquidity strain. That might not spell crisis in the short term, but it tightens Porsche's flexibility for marketing, innovation, and scaling its electric transition. In response, Porsche revised its 2025 outlook. Revenue forecasts dropped from 39 to 40 billion euros to 37 to 38 billion euros. And margins were cut from double digits to as low as 6.5%, a number that investors, used to Porsche's premium edge, found deeply unsettling. This wasn't just an off quarter, it was a warning shot, one that highlights just how vulnerable Porsche is to the economic and political tides sweeping through the global car market. And at the center of that storm, a policy move from Washington that hit Porsche harder than almost any other automaker. The tariff crisis. US trade policy slams Porsche's margins. In 2025, the US government implemented a sweeping 25% tariff on all imported vehicles. The goal? Support domestic manufacturing and counter global trade imbalances. But for Porsche, a company that manufactures entirely outside the United States, This was a direct hit to the heart of its North American business. Unlike BMW or Mercedes, which operate plants in the US and Mexico, Porsche has no North American production base. Every car, whether a 911, Taycan, or Cayenne, is built in Germany, Slovakia, or other European facilities. That means every Porsche sold in the US now carries a 25% import tax. According to Porsche CFO Jochen Breckner, the company absorbed $114 million in tariff-related losses in just 2 months, April and May 2025. That's before any customer saw a price change. Porsche made the call to eat the cost up front, hoping to preserve brand perception and customer loyalty. But that choice has consequences. It slashed already thin margins on US models, especially in the SUV segment. While 911 and Taycan customers may tolerate price bumps, buyers of Macan and Cayenne, Porsche's sales volume engines, are far more sensitive to cost. There's no short-term fix. Porsche hasn't announced any plans to build in the US, meaning they're fully exposed to ongoing tariffs. Unless policy shifts or the company pivots, these losses could continue quarter after quarter, and Porsche's headaches don't end with the US. Across the globe, another storm is brewing in China. From boom to backslide, Porsche's struggle in China. For the last decade, China has been Porsche's crown jewel, a market where luxury, technology, and status converge. Chinese consumers helped fuel Porsche's global rise, especially as they embraced SUVs and electric models at record speed. But in 2025, China is no longer Porsche's safety net. It's quickly becoming a liability. Economic growth in China has slowed. Rising interest rates, consumer caution, and increased competition from domestic luxury EV makers have shifted the balance. In the first quarter of 2025, Porsche reported a sharp slowdown in Chinese deliveries. While the company didn't break down exact numbers by country, it admitted that China contributed significantly to the global 3% drop. Luxury fatigue is part of it, but policy, pricing, and perception play even bigger roles. For Porsche, that's a serious problem. China has long accounted for nearly a third of global deliveries. So what's Porsche doing internally to respond? That brings us to its most defining operational decision: where and how it builds. A legacy that's now a liability. For decades, Porsche's insistence on building all vehicles in Europe was a point of pride. Made in Germany wasn't just a slogan, it was a promise. It meant unmatched quality, consistency, and control. But in today's climate, that very strength has become a strategic weakness. With US tariffs in place and China's regulatory environment becoming more unpredictable, Porsche is uniquely exposed. Brands like BMW or Mercedes can cushion these blows thanks to North American and Asian production plans. Porsche cannot. Jochen Breckner confirmed in Q1 that no plans exist to localize production in the US. No operational safety net if global shipping gets tighter. This is not a short-term fix. Building a new plant takes years and billions of euros. But refusing to even begin that process leaves Porsche boxed in. Internally, the company is turning to cost-cutting measures, logistics optimization, and focusing on higher-margin models. But those are defensive moves. They won't fundamentally change Porsche's exposure. In 2025, being made in Germany is still prestigious, but it's also becoming painfully expensive. So where is Porsche shifting its long-term hope? Toward the quiet hum of electric power. As Porsche faces pressure on all fronts, its strategy for survival and success is clear. Go electric, fast. The Taycan, Porsche's flagship EV, has held up surprisingly well in 2025. While overall sales declined, Taycan demand remained relatively steady, proving that luxury EV buyers still trust the brand in this evolving segment. Now, all eyes are on the Macan EV, expected to launch globally in the second half of 2025. It's positioned as Porsche's volume electric SUV, targeting both loyal Porsche fans and new EV-first buyers. The company hopes this launch will rebalance the portfolio, giving it cleaner margins, EV incentives, and a modern platform to scale innovation. Government subsidies in Europe and Asia, combined with growing pressure to phase out combustion engines, are giving Porsche a reason to bet big on electrification. The target, 80% of Porsche's lineup electric by 2030. But that vision depends on whether Porsche can maintain profitability in EVs, which have higher battery costs and typically lower margins at the start. Still, if any brand can bring performance and luxury into the EV era, it's Porsche. That Jochen Breckner stepped quietly into one of the most high-pressure roles in the industry, Chief Financial Officer of Porsche AG. For most executives, the first months in office are a time to listen, observe, and carefully ease into the responsibilities of command. But Breckner had no such luxury. Within weeks of assuming the role, he found himself at the helm of Porsche's financial strategy during what would become one of the brand's most sobering quarterly earnings calls in over a decade. The numbers were stark, profits were declining, margins were narrowing, and forces far beyond Porsche's own production lines were threatening the iconic brand. Yet Breckner's response was neither panicked nor theatrical. Instead, his demeanor reflected something rarer in moments of pressure: measured clarity. He didn't sugarcoat the situation, he presented the facts. A 43.8% drop in automotive profit, a $114 million tariff burden, and a downward revision of 2025 revenue and margin forecasts, with the kind of quiet precision Porsche itself is known for. But Breckner's value doesn't lie solely in his ability to read numbers. It lies in his understanding of when to act and when to wait. While others might have leapt toward dramatic solutions, slashing prices, shifting production, or chasing short-term market gains, Breckner has shown a deep commitment to the long game. In this way, Jochen Breckner is less a stopgap leader and more a steward of transformation. His decisions, though quiet, are powerful, because as Porsche grapples with rising tariffs, softening Chinese demand, and tightening margins, it's Breckner's calm hand that may determine whether this storm leaves Porsche merely bruised or fundamentally changed. His leadership, now tested, will not be judged by immediate recovery alone, but by how well he preserves what makes Porsche Porsche in an era that demands both tradition and reinvention. Now, let's bring it all together. What does this all mean for Porsche's future? Final thoughts: what this 3% drop really tells us. At first glance, the news seemed almost forgettable. Porsche, one of the world's most revered automotive icons, had posted a 3% drop in global sales during the first quarter of 2025. Not 30%, not even 10%, just 3%. In a world of financial turbulence and shifting consumer habits, such a figure could easily be brushed aside as seasonal noise or a temporary soft patch. But this wasn't just any brand, and this wasn't just any number. Beneath that modest slip lies a far more compelling story, a slow but undeniable tightening of the gears behind Porsche's famously smooth machine. The decline, however slight, cracked open a window into a brand standing at the crossroads of tradition and transformation. Behind it is the mounting weight of geopolitical tension, supply chains still healing from years of global disruption, and the invisible pressure of a market that no longer guarantees loyalty simply for legacy. Porsche is not in crisis, but it is without question being tested. They're existential ones, because Porsche is more than a car maker. It's a symbol of control, of excellence, of engineering without excuses. But the road ahead is no longer paved in certainty. It winds through rising tariffs, slowing economies, and accelerating change. That 3% drop, it may have seemed like a whisper, but for those who know where to listen, it echoes with the sound of something deeper, a brand being challenged, not at the surface, but at its core. And now, the question is no longer about numbers, it's about what Porsche becomes next. The decisions made in the next 12 to 18 months will shape Porsche's next decade. And as a symbol of German automotive excellence, those decisions will also send a message to the entire industry. Porsche has always been more than a car company. It's an icon, a name that evokes emotion, performance, and pride. Now it's facing a test, not of its engineering, but of its strategy, speed, and strength. And if history is any guide, never count a Porsche out. So what does a 3% sales slip really reveal about a brand like Porsche? Porsche's 3% sales drop in 2025 might seem like a ripple on the surface, but beneath it lies the movement of much deeper tides. From global tariffs and economic tension to evolving consumer behavior and the high-stakes pivot to electrification, Porsche is navigating a crossroads that will define its legacy for years to come. It's not just about numbers anymore, it's about identity, adaptability, and the balance between heritage and reinvention. Whether it emerges leaner, sharper, and future-ready, or risks losing its edge, depends entirely on how it steers through the challenges ahead, and that story is far from over. The road ahead for Porsche is uncertain, but if you've been watching closely, you know it's going to be one hell of a ride. If you enjoyed this breakdown, hit that subscribe button, tap the bell, and drop your thoughts in the comments. We'd love to hear where you think Porsche goes from here.